Hey, good afternoon, everyone. This is Sami Abusaad with T3 Live. I hope everybody's doing well. I was going to do a live video earlier this afternoon, but got a little busy with a trade this afternoon, and I just didn't really want to distract myself. And then I would have also done a video right after the close, but I had the nightly game plan tonight. I hold three swing trading sessions on Monday, Wednesday, Friday with the nightly game plan members after the close. And today being Wednesday, we had a session today. So here I am doing a live Facebook video when most of you are probably having dinner. But I'm on the West Coast, so it's still early in the day for me. At any rate, today's video is about one of the most overlooked concepts in technical analysis, and the concept is the concept of reward to risk. Okay, novice traders brag about how much a stock moved in their favor, as though that means anything. It really doesn't, unless you tell me your share size. Because what if I tell you that a stock moved $20 in my favor, but I only had 5 shares? How impressive would that be? That wouldn't be very impressive at all, right? But what if I told you a stock moved 20 cents in my favor, only 20 cents, but I had 3, 4, 5,000 shares? Would that be impressive? Should be, right? Because that would be several $100s at least, right? 600, 700, 800. Whereas a stock moving $20 in my favor and on 10 shares, that would only be, did I say $10 in my favor? 10 would be $100. If it moved $20 per share and I only had 10 shares, that would be $200. That wouldn't be very impressive at all. So again, your reward is only meaningful if you disclose your share size. But your share size is determined by the size of your stop, right? If you subscribe to the concept of risking a set amount of money on each trade, this is a concept that was discussed in great detail by Van Tharp in his really excellent book called Trade Your Way to Financial Freedom. Then your share size is determined completely by the size of your stop. And the size of the stop is the difference between your entry and the stop price. So assuming a long position, let's say your entry was at $10, your stop was at $9.90, then your stop size would be 10 cents. And that's also called the risk on the trade, would be 10 cents. So if you risk $100 per trade, then what should your share size be? Assuming, again, a 10-cent stop. Obviously, 1,000 shares, right? So if we take out the calculator, we don't need a calculator for this, but you risk $100, right? So 100 divided, oh, you're not seeing it. So 100 divided by, where's the division? Divided by 10 cents. That tells you, that determines your share size. In this case, it would be 1,000 shares. If the stock moved just 20 cents in your favor, 20 cents, that's actually meaningful, because now you can say that you have a risk to reward, or a reward to risk rather, of 2 to 1, which is usually a decent ratio to have, unless you bat really high. The higher your batting average is, the lower the reward to risk required. Okay, the higher your batting average, the lower the reward to risk required. Now, to make things really simple, what I do is I keep this spreadsheet. I mean, I actually printed it and I put it I taped it to my monitor. But a table like this that tells me, based on the size of the stop, what my share size should be. So I don't have to take out a calculator or do it in my head, right? I can just eyeball it real quickly. and figure out the share size. I risk $500 per trade on day trades and then $1,000 per trade on swing trades, right? So let's go back to 500. So if my stop is 15 cents, then I know to get 3,300 shares, right? Long or short doesn't matter. If my stop is 50 cents, then I know to get 1,000 shares. After a while, if you stay with the same risk unit for a while, then you don't really need to look at it very often, right? Most of the time, you know what the share size should be right away. And this is also in pennies, right? So that's 70 cents, 80 cents, 90 cents, a dollar, $1.25. Notice that the range here expands. In the beginning, the range between, one level and the next, in the beginning, it's penny by penny because each penny is meaningful. As a percentage of the stop, it's very, very big, right? Here it's 1/5. Whereas here, a penny, like if the stop was 80 cents or versus 81, it wouldn't matter if I got 600 shares or, right? It doesn't matter. So the range expands as the stop also increases. So I recommend keeping something like this taped to your monitor so that you know what to risk or what share size to get when a trade comes up quickly. All right, so that's an idea, but really the concept of reward to risk is probably the single most overlooked item in technical analysis. Let me show you what I did today. As far as day trades, actually, I just did 2 trades. The first one, I'll just show you the first one real quick. First one was CC, and it just wouldn't work. So short, high-low entry. I like high-low entries. This daily chart, 5-minute chart, gap down today. I thought I would get to the 200, like around 44.75 maybe, and it triggered, looked good, and then the market wouldn't cooperate, and this wouldn't cooperate. So it went back up. When it came back down, I took half. Because you know why I took half, by the way? Because now it's a sell setup, and the low of the day becomes target 1. This was an official play in the black room, but again, it didn't really work that well. So initially, I wasn't going to take anything, but notice it went against me, and now it's a sell setup, and target 1 on a sell setup is always the prior low. So I took half there, and in the back half, I killed at 45.75. So once this bar's high got taken out, just above it, I just killed it. It's good that I killed it because it would have stopped out actually. So this barely made any money. The other trade though, I just want to show you the other trade, which was, what was the symbol? It was TROX. TROX this afternoon. So let me show you this trade on the 15-minute chart. Does anyone know what this pattern is called? This video is being done live, so some of you are probably listening as I'm speaking. That's called a 1-2-3, right? A 1-2-3 pattern, which is a classic. It's a classic 1-2-3 pattern that we teach in the manuals, in the classes, Trading the Pristine Method class. We also play it a lot in the black room. Not only is it a 1-2-3 play, it had a kind of a shakeout or a breakout failure. See this little topping tail? Now, if I show it to you on the smaller time frame, you'll see how meaningful it is. This stock basically, look at this, on 50,000 shares, tried to go higher and got slammed. So meaning traders got caught, right? And here's the 5-minute chart. Nope, it's right here. There it is. So you can see it better than the 15. But so it had a 1-2-3, 1 being the igniting bar, 2 is the resting, the narrow range bar, and then 3 the trigger. In this case, it really had a 1-2-3-4. 1, 2, 3, and 4 triggered. So this was an official play called in the black room, short under 1905 by 1920, 1919. 15-cent stop. So obviously, what's my share size? 15 cents, because I risk $500 per trade, 3,300 shares. Right? Does that make sense? Okay, and then the target, it's a sell setup in this case because it rallied and then gave us a sell setup, a slight base breakdown, but also a rally and a sell setup. So low of the day was target 1. I was really hoping it would go more than the low of the day, so I took half there. Notice how small it is. I mean, I can hardly point it out because of how small. Here it is. But it was meaningful because I had 3,300 shares. Because the stop was tight. Here's how small the stop was. right? This is how small the stop was. So very small stop. The smaller the stop, the bigger the share size. Again, one more time. The smaller the stop size, 5 cents, 10,000 shares. 6 cents, 8,300 shares. 7 cents, 7,000 shares. The larger the stop, $1.50, 300 shares only, right? So the larger the stop, the smaller the share size. So even just to drop from here to there made a good amount of money. And then the back half really didn't go anywhere. Okay, at the end of the day it dropped, and I closed 1/4 somewhere in this space, and then the last lot here. So 3 different exits, and it made, look, it made 2 R's almost, just $40 shy of 2 R's. 2 R's means 2 risk units. So I risked 500, I made 1,000, almost 1,000, right? So, and how much did it drop? 20 some cents. That's it. So the concept of reward to risk is huge. Okay, don't miss it. Yesterday, the same thing I believe happened in one of the plays. I think it was. You know what? I'll just open my P&L from yesterday, and I'll tell you which symbol it was. 1 second. Okay, it was Fran. Yeah, Fran. So here's my P&L from yesterday. I had one big mess up yesterday, and I'll show it to you. It was the EIX. I forgot to cancel my stop once I exited the trade, and of course some news came out, and I gave back $700, I think, or more. So that was bad. But Fran, notice my biggest play. It really wasn't supposed to be my biggest play. The EIX was my biggest. It was called also officially as an official play in the black room, EIX. I'll show it to you later, but let's take a look at the Fran. What did I do with the Fran? What was the play on Fran? Wow, nice base breakdown. We discussed it in the black room also today. That was today. But here's the play yesterday. I'll just show it to you. Okay, it was right at the open, and I'll show you what I did. I'd have to go back, scroll back to yesterday, and here's yesterday. Takes a while when it's on the 1 minute chart, but here's what I noticed. The stock dropped to the prior lows. If you've heard me speak before, if you heard me talk about breakouts and breakdowns, then you would know that my favorite breakdown pattern of all time is when the stock goes in a downtrend, goes to support and bases at support, right? And then you get a breakdown. In this case, it wasn't much of a base. It was just kind of a 1, 2, 3. But where at? At the low of the day. If a stock drops the low of the day, it should bounce, right? It didn't. So just a quick scalp. Look at this. 1 penny stop. Bam. Oops. Let me show you. Here it is. So 1 penny stop. And then I was out at 11, 7-11, right here. I did 4,000 shares, so that made like $400 or something like this. Wasn't that much. And then another play. I'd have to go to the 5-minute chart and scroll back to show it to you. On the 5-minute, I think it was on the 5. Is this today? That was yesterday. Okay. So here it is. In the afternoon, short under 7 by 703, or 701 by $7 by 703, short. I didn't get filled much because at that point it was on an uptick. Otherwise, this actually really should have made a lot of money. But I didn't. It was on an uptick already, so I didn't get filled much. But between the two, made about $800, right? So why was this a nice move, even though it dropped probably, look at this, it dropped like 15 cents at the most, 17 cents, because of the size of the stop, right? So when the stop is small, then even a small drop like this becomes really good, meaningful, right? But when a stock is down more than 10% on a day, or 10% or more on a day, then it goes on an uptick for the rest of that day and the next day as well. So this was on an uptick in the afternoon, whereas it wasn't in the morning. Let me show you that EFX or EIX. I just wanted to show it to you and show you what happened. I didn't feel that bad about it because it's an honest mistake, right? When it's an honest mistake, I don't mind it. When it's a mistake that's the result of discipline or lack of discipline, then that does hurt. But here's the play. It was called in the black room. Pretty great play, basing at the prior lows. Another base breakdown that was basing at support. So here's the line. Let me show you first. Let me draw it so you can see what it is. So stock is in a downtrend, right? Bounces, comes back down, and bases at the lows, just like I like it, right? Perfect. So that was the entry right here, and then I took it at the lows. No, not quite at the lows. I don't remember the exact exit, but maybe in this bar, it dropped a little bit afterwards. But nice little play. Well, took it, and then I was gonna trail it to 61. I don't know where 61 is here, to 70.60. So on the way down, I told the black room, let's lower the stop to 70.61, and I did. I put it in my platform, and then I exited, right? And I forgot to cancel my stop. So when this happened, I got, I lost $700 when this happened. So this was kind of my own fault, but like I said, it's what I call an honest mistake. So, whatever. All right, guys. Well, I hope you enjoyed today's video. I thought it would be a much shorter video, but whatever it is, I hope you enjoyed it. Join me in the black room if you like to, if you want to participate in trades like these and more. By all means, join me in the black room. Also, I don't know if you saw the video by my co-moderator and friend Ifan, who's a moderator in the black room with me, called Trading Void and Momentum. He just did the video today. I thought it was a phenomenal video. Check it out. Again, Trading Void and Momentum by Ifan. And hope to see you in the black room. Thanks, guys.